Welcome back to What's Hot, What's Not, CRE. It's Monday, April 6th, 2026, kicking off the week with the latest residential and multifamily data. Let's get into what changed. First up, what's hot? Occupancy is recovering. Conventional apartment occupancy reached 89.4%. That's nearly a 2-point year-over-year increase. Stabilized assets are even stronger at 93.7%. It seems operators prioritizing occupancy over rent growth is a strategy that's working. Supply relief is here. Completions are projected to drop 24% in 2026, down to 450,000 units from 595,000 in 2025. Construction starts are at their lowest levels in years. The absorption-to-delivery ratio is finally improving after staying below 1.0x for most of the past 2 years. The Northeast and Midwest are outperforming. Hartford and New Haven started 2026 with vacancy rates below 1%. And get this, San Francisco is posting 5.9% year-over-year rent growth, leading the nation. The Northeast is projected for 4 to 5% annual rent growth, with the Midwest expected at 3 to 4.5%. It's a classic case. Limited supply plus healthy absorption equals pricing power. Build-to-rent demand also remains strong. Renters want space, privacy, and professional management. J.P. Morgan Asset Management is actively investing in BTR developers, with Nashville and Atlanta as key target markets. Home builders are also diversifying into BTR communities to capture that permanent renter demographic. And finally, barriers to homeownership continue to support multifamily. Renting is cheaper than owning in all 100 of the largest U.S. metros. With mortgage rates averaging around 7%, the buy versus rent premium continues to push demand squarely into apartments. Now, on the flip side, what's not? National vacancy is still elevated. The apartment vacancy rate hit 8.6%, which is the highest since the post-financial crisis recovery. The historical average is around 6.9%. Simply put, the nearly 1.8 million units delivered over the past 3 years have outpaced absorption. The Sun Belt is still working through its oversupply. Dallas-Fort Worth vacancy is at 12.2%. Austin, San Antonio, Phoenix, Nashville, they're all navigating elevated lease-up pipelines. This means operators are competing hard on pricing. Concessions are still widespread, especially in new construction and top-tier price points. Rent growth also remains muted nationally. Asking rent growth decelerated to just 0.1% year-over-year, the weakest pace since late 2010. While growth is projected to return to the low single digits, 2026 is really about normalization, not acceleration, and we're seeing build-to-rent construction slowing. Single-family built-for-rent starts fell 19% in 2025 compared to 2024. Higher interest rates are cooling investor demand, and potential legislation could require institutionally financed BTR units to be sold within 7 years, putting approximately 40,000 units per year at risk. So, why it matters. The multifamily market is bifurcating by geography. Coastal and Midwest markets with supply discipline are seeing rent growth and tight occupancy. Meanwhile, Sunbelt markets with heavy deliveries are still in absorption mode. That national vacancy rate really masks significant regional divergence. Transaction volume is recovering. We're seeing prices rising steadily over the last few months. Investor confidence is increasing that the market is nearing its low point, and we expect selective cap rate compression for quality multifamily assets. Your investor takeaway: geography matters more than ever. Target Northeast and Midwest markets with supply constraints. Be cautious in the Sun Belt until absorption catches up. Occupancy is recovering, but rent growth likely won't accelerate until 2027 or 2028. The supply wave is cresting, so position for the recovery. That's your Monday multifamily update. Thanks for tuning in. Don't forget to like, share, and subscribe. Visit hotnotcre.com to learn more and subscribe to our newsletter.